My dear friends, welcome to Rajashekar classes. This is lecture number 23. In this lecture, we will try to understand liquidity ratios of stocks. This comes under understanding key metrics for financial analysis. What are liquidity ratios? What is its purpose? Liquidity ratios measure a company's ability to meet short-term obligations. They assess the financial health and operational efficiency of a business, commonly used by investors to evaluate stock performance. I can say liquidity ratios are financial metrics used to assess a company's ability to meet its short-term obligations and maintain sufficient cash flow. These ratios provide insight into a company's financial health and its ability to convert assets into cash to cover liabilities that are due within a year. What is the importance? What is the importance of liquidity ratios? I can say they are important because they indicates financial stability. They helps in identifying companies with potential financial risks. They are key to determine the ability to convert assets into cash. These are important. These ratios important. They are essential for stock investment decisions. Liquidity ratios are vital for understanding a company's ability to operate without financial strain. Regular monitoring and optimization of liquidity are essential for long-term success. What are the key liquidity ratios? What are they? They are current ratio, first one. Second one is quick ratio or acid test ratio. Third one is cash ratio. Let us try to understand one by one. What is current ratio? What is the formula for current ratio? Current ratio is current assets by current liabilities. It indicates the company's ability to pay short-term debts. Let us take one example. Let me consider there is a company ABC. Its current assets are let me say this this is the number for current assets. These are current liabilities. Then how can I calculate current ratio? Anybody can understand current assets by current liabilities. If I calculate, what am I getting here? 2. What is this 2 indicate? This is important. This interpretation is very important. What it interpretation says, this ABC company has $2 in assets for every $1 of liability. This I request you to understand this particular interpretation. In similar manner, I can say quick ratio means acid test ratio. What its formula? Current assets minus inventory by current liabilities. Let me take one more example. I am assuming current assets this number, inventory is this number, current liability is this number. Just I am substituting this so that I am getting 1.5. What is its interpretation? Interpretation is important. Interpretation is XYZ company has $1.5 in liquid assets for every $1 of liabilities. What is this? What it measures, acid test ratio or quick ratio measures the ability to meet obligations without relying on inventory. What is this last one, third one? Cash ratio. Cash ratio is nothing but cash and cash equivalents by current liabilities. What is the, just let me assume some number. Cash is this number, liabilities is this number. Just if I calculate, I am getting 0.6. What is the use of cash ratio? Means, so I can say, just what is the interpretation? Interpretation is this DEF company has $0.6 in cash for every $1 of liability. Isn't it? Just I am assuming some numbers and explaining. These are the simple calculations, elementary calculations. Anybody can understand these calculations. Application in stock analysis. What is the first application? why liquidity ratio matters for stocks. High liquidity ratios indicates financial stability. Investors prefer companies with higher liquidity during economic downtrends. Low ratios may signal financial distress or over leveraging. I can say it's a low ratios may signal financial distress. What are the limitations of liquidity ratios? Do not account for market conditions or operational efficiency. Overemphasize may overlook long-term growth potential. Ratio vary by industry. Context is crucial. It may vary from industry to industry. What is our conclusion? What are the key takeaways? Means liquidity ratios are essential for evaluating financial health. Use them in conjunction with other financial metrics. Always consider industry norms and economic conditions. Just go through this lecture. Thank you very much.